Okay, hi guys. Right, so today what I will be doing is, I'm sure you guys know about something called the pre-mock, right? So ACCA, what they do is before every session, right? Before every session, so meaning December, March, June and September, just before the session, 1 month ahead, they they what do you say, they release something called the pre-mock. So what is this paper? It is something that they expect you to time. Okay, so they expect you to time yourself and sit for the paper and mark it yourself and see if you are ready for the exam. Okay, now don't think that your real exam will be like very similar to the pre-mock. Okay, because if that was the case, then it doesn't make sense, no? Okay, in terms of the structure, in terms of the way in which the questions are laid out, all of that might be similar, but don't expect the same question to come from the pre-mock in your real paper, because the people who are making your real paper, they are the ones who make the pre-mock also. Okay, so actually what is this paper good for? It's good for practice, because they tend to ask as many areas as possible. Okay, so compared to your real paper, it might even touch more areas than usual, right? So today what we will be doing is, we will go through that entire pre-mock. If you have any questions, you can ask me. They also release the answers, but they have video releases, but they don't touch every question. Okay, so that's why I want to do it in class, so each and every question is touched. And to be honest with you, this December session, for some reason, the pre-mock is very comprehensive. Okay, meaning we have questions from so many different areas. Compared to the previous sessions, we have a lot of questions from different areas. So in terms of practice, in my opinion, it's a very good paper, right? So how do we access this pre-mock? So let me show you how that's done. Give me a second. Okay, so actually the easier way is go on Google basically. Okay, so click on the first link that you see, and you will be able to see access the pre-December mock on the practice platform, right? So that's where you need to go. And then put in your ACCA registration number and password. So at this point, I hope you are actually looking and using the practice platform, okay? Because it's not just a matter of answering the questions. You should be able to put it in that Excel sheet or the word sheet that they're giving you, right? So that's very important. So make sure you do practice questions on the system, the practice platform itself. You see, it's a little slow. Just give me a minute, I'll check if something's up within it. Hello. Dashra, the internet is a little slow, I think. Yeah. I need to get this pre-mark. It's taking a long time to load.
Alright, Miss Roxy.
Is it okay?
Yeah, can you show me this?
Okay, I think it's fast. I'll assign
Okay.
it. Yeah. Okay, so once you get into this practice platform, you need to go to financial management and go for ACCA official resources and practice exams. Okay, so under that you will have the FM pre-December 2024 mock exam. You need to assign that to yourself. Okay, so when you do that, that particular paper should fall under this self-assigned material. Okay, so it will be here. You can see you have FM pre-December 2024 mock exam. You can go ahead and start it. Right, so basically guys, what you see on the screen, okay, so there are two reasons why I did this paper. One is I want to make you familiar with what you will be seeing, right? But I believe most of you would have sat for, other papers. It's the same thing, nothing different, okay? So this is what you will see when you go for your exam as well. General instructions, you can read through it, and then they're just telling you the different options that you have. You can highlight the question, you can strike through, all of those things you can do. Okay, so play around with it, play around with a laptop. Okay, so don't use a tab or a phone. Most of the functions, they don't work properly with tabs and phones. Okay, so please use a laptop or a PC to actually get the feel of how this system works. Right, so let me start, okay? So somebody sent me a message asking where the formulas are given, right? So I don't know if you can see here. I think I am covering it. Yeah. So you can see here, right at the bottom, on the left hand side, there is something called help or formula sheet, right? So if you click on that, you get these exam instructions. That's basically what you read just before you started the exam. Something called question help and something called a formula sheet. Okay, so what is actually important for us is this formula sheet. So whatever formulas that you need is available here. So the EOQ, MILA, or everything is there together with the tables, the present value table, annuity table. Okay. Right, so this is basically they're asking, they're showing you how to use the Excel sheet and how to use the word sheet. So just have a look at it before the exam. Don't go to the exam and waste time reading this, okay? Exam instructions, like I said, what they actually displayed at the beginning, right? So then on the right hand corner, you can see previous, next, that's the question. Navigator, if you click on that, you can jump to any question that you want, okay? So let's say for example, the exam you have answered all the questions, just one question 4 you didn't answer. Then from the last question, you can directly jump to that question. You don't have to go back so many times, okay? Then this flag for review, in case there is a question that you are not sure, okay, then what you can do is you can flag it and move on to the next question. So then what happens is when you open the navigator, now question 1 I have flagged, no, it will show as a red flag there. So towards the end of the exam, if you want to know, you want to go back to a question that you have incompleted, that is incomplete, you can simply click on that. So it acts like a bookmark. Okay, so that is that. And then you can highlight, strike through. You have a calculator here. If you want, you can use it. There is the scientific version as well as the standard as well. So it's up to you. But again, in my opinion, better take your own cal because you're comfortable with that. Okay. But suppose, it happens to people, battery doesn't work. Okay, something happens to the cal. Then, unlike in the past, you still have a calculator, so no issues there. Scratch pad, this is actually important, especially in a situation where you don't have paper, pen and paper, right? Now, most of the time you don't get, okay, but you can request for it. But in case, I'm telling you, worst case scenario, you don't get it. Now, when you're doing MCQs, you can't do workings in your head, no? Okay, obviously it's not possible. You need paper, right? So, in case you don't have that at your disposal, then you can use what is called this scratch pad. So, basically, it works like a typing pad where you can type in whatever you want. Okay, so if you want to do certain calculations, you can do that using this scratch pad itself. Okay, right? Okay, so that's it for just walking through the platform. So now let's go ahead and start. Okay, so if you look at the first question, this is obviously section A. You will have 15 short questions. The first question is saying Cosmos company is exploring a new project with a lifespan of 4 years. The project promises robust returns of a positive net present value of 400,000 when discounted at an annual rate of 10%. Okay, so what are they saying? They're saying there is a new project, okay, and the lifespan of that project is 4 years. Fine. And they are saying that the net present value also we have calculated, it is 400,000 if we use the discount factor at 10%. Okay. These estimations are based on expected cash inflows of 500,000 annually over the project's duration. Taxes payable 1 year in arrears at a rate of 30%. So they are saying, how did I calculate this 400,000 positive NPV? I did that based on expected cash inflows of 500,000. So they are telling me that. Okay. And they are saying taxes paid in arrears. Fine. Question is, what is the change in the annual cash inflows which will make the net present value 0? Meaning, how much should these cash inflows change by if this positive 400,000 has to become 0? That's the question. Okay, so I'll give you a minute. If you can figure what exactly they are asking. They are not using the exact word here. Okay, it's actually kind of tricky because they are not telling you what to do, but they have given you the idea of what has to be done. The word itself is not used. Okay, what do you think they are asking to calculate here? When do we calculate when an NPV becomes 0? Something that was positive is going to become 0. In which method did we do that kind of a calculation? That's what you should be thinking at this point. Okay, so think through, and if you have an idea, let me know in the chat. Any idea? When did we calculate when an NPV becomes 0? Good. I have the correct answer from one person. Okay, so there was only one situation where we used to say this, right? If this particular variable changes by this much, NPV will become 0, project is no longer viable. Right? So, when did we talk about this? We spoke about it in an area called sensitivity analysis. So, by default, if you do sensitivity analysis, what are you actually doing? You are calculating how much a particular variable has to change in order for the NPV to become 0. So, that's exactly what they are asking. Okay, they are asking you to calculate how much should that inflow change by if the NPV has to become 0, right? So what you need to do is calculate sensitivity to that particular cash flow, right? So the equation that we used was this: sensitivity equals to NPV over present value of after tax cash flow. I'm mentioning after tax here because they gave the tax rate, so chances are that we have to use that. Okay, if they didn't mention it, then we can just take the present value of the cash flow itself, right? So using this equation, we need to calculate sensitivity. Okay, so let me see what we have in the question. Right, so clearly NPV is there. Okay, so I'll highlight that. Let me see if I can, because again, like I said, I'm using a tab. Yeah, it's not possible to do it in the tab. In your exam, you can highlight, right? So NPV is there, and the cash flow that they're talking about is also there, 500,000 cash inflow. Okay, and we have the tax rate also. So get the present value of that 500,000 first. We know the lifespan is 4 years, and then using the NPV equation, using the sensitivity analysis equation, you can get the percentage. Okay, so I'll give you 2 minutes. See if you can do that. Okay, try it out. Okay, so let me get the present value first, but you have to be a little careful, okay, with regard to this present value. Right, so the question is saying the lifespan of this project is 4 years. right? So then what's going to happen here actually, if I'm going to get present value, I take the years. For 4 years, that is from year 0 all the way to year 4, there is going to be a cash flow of how much they told me in the question. They told me there is expected cash inflows of 500,000 annually. Okay, so that will be there in the first 4 years. So that will be 500,000. Now I need to discount this. Now clearly this is an annuity, so I need to take annuity factor at 10% for 4 years. Okay, so I will go to the annuity tables. So 10%, how do I know it's 10%? They told me it's discounted at an annual rate of 10%. So that's why I know it's 10%. So if you look at the 10% 4-year figure, it is 3.170. Okay, so that is the annuity factor that I will use. 3.170. That will give me the present value. So let me get that figure first. So 500,000 into 3.17. So that will be 1,585,000. Okay. Now usually if there is no tax involved, we can stop here. Okay. But here in this question they are talking about a tax that is paid in arrears. So that means now there are 4 years anyways, right? But we don't start paying tax in year 0 itself. We are going to pay 1 year later. Okay. So that means I'll just draw the timeline for tax. Year 0, year 1, year 2, year 3, year 4 and year 5 also I need. Okay. Now how much is the tax that I'm going to pay? It's 30%, right? So 500,000 into 30%. Okay. So that will be the tax amount that I'm going to pay. So that will be 150,000. Now this 150,000 guys, what is going to happen? I'm going to pay 1 year in arrears. So you have to be a little careful here. Okay, so it's what we call a delayed annuity. Okay, so it's called a delayed annuity. So I have 150,000, 150,000 and 150,000. Okay, so what I will have to do here, sorry, it's delayed now, so it has to go one to the right. Give me a second. Okay. So the first payment happens 1 year later, 150,000, 150, 150 and 150. Okay. So now if I want to make this 150,000 present value, first I have to take the annuity factor and then that will only bring it back by 1 year. Okay. And then again I should use the discount factor for 1 year and bring it back to year 0. Okay. So be careful what you do there. Right. Okay, so let me look at the annuity factor table again. Right, so yeah, so if you look at how do we get the figure, is it going to be for 5 years or 4 years? I'm sure you know that by now. We know that we are talking about a 4-year period. I always say count the gaps. So 1, 2, 3, 4. 1, 2, 3, 4. Okay, so 4 payments, right? So we need to bring this back by 1 year. So for that we take the annuity factor of 3.17. Okay, and that will bring it to year 1's terms. From there we have to bring it to year 0. So what we do is we go to the present value table. Okay, and bring it back by 1 year, which is 0.909. Okay, so if you are not sure what happened here, please look at the first few chapters that we did where there was a topic saying delayed annuities. Okay, so what do you do when there is a delayed annuity, right? So this 3.170 is the annuity factor for 4 years, 0.909 is the discount factor for 1 year. Okay, right. So then what we can do is this 150,000, it's going to happen from year 2 to year 5. Okay, we will discount it by 3.170 into 0.909. Okay, so that should give me, I can do the multiplication and give the answer and then do the present value. Okay, so 3.17 into 0.909, that will be 2.882. So now the 150,000 I will multiply it by that. And that will be 432,300. Okay, so now you can deduct the two figures. You will get 1,152,700. So that's going to be the present value. Okay. Right, so you have the present value. NPV you already knew it was how much? A positive 400,000. So to take sensitivity, it's 400,000 divided by 1,152,700 into 100%. So sensitivity will be 34.70%. Okay. Take it down. So you're saying option 1. Let me see what that answer was. 34.7 is actually option C. Okay, the answer should be C then. Is it clear? Any questions, guys? Okay, so that's how in this paper you will have a little tweaks here and there, right? Because now see, we have never taken two cash flows and done sensitivity before this, right? Except for when we used contribution. Okay, sensitivity to sales volume. When we use contribution, we consider the sales as well as the variable cost, right? But here now see, in this question they suddenly put in a tax component. Right, so that is the importance of practice. Get it? The more you practice only, the more you will understand how to tweak your answers a little bit. Because now see, unfortunately, this is an MCQ. Right? So even if you got the first part right, even if you got this 1.585 million, it won't make a difference anymore. Why? Because what's the point, right? Because you will do everything based on 1.585. You will anyway get the wrong answer. You will choose that and move on. How does the examiner know that you did half the question correctly? Right? So that's what I'm telling you. Always keep on practicing. MCQs are the place where people tend to lose marks because of lack of practice. Okay? Right. Let me know once you're done taking it down. Okay, right, so that is the first question, right? So let me move on to the next one. Right, so select the answer and move on, right? Right, so here I'll just read the requirement and I'll give you some time. It says, should tech company plan to adapt its existing capital structure for the new investment proposal? Determine the revised cost of equity for tech company in the hospitality sector. So they're saying if should means if tech company plans to adapt their current capital structure, what will be the new cost of equity? So it's a risk adjusted cost of equity calculation. So if you remember, you need to re-gear, de-gear, all of that, and then try to get the cost of equity using CAPM. Okay. So read through the question. This is something we have done many times. See if you can do the entire thing, right? Now again you might think it's a big calculation, only 2 marks. What to do? MCQs are like that, right? Okay, so I'll read through. If you're comfortable, continue. Okay. It says tech company, a successful software company seeking to diversify into the hospitality industry amidst the market saturation in their current sector. Okay. So they're saying there is a company. Okay, I'll just explain the situation first. There is a company who is currently in, I can't remember what was the sector. They said they are a software company and they are trying to diversify into the hospitality sector. Okay. Then they're saying tech company aims to ascertain its cost of equity for evaluating the new investment proposal. So they want to see the cost of equity in the hospitality industry. So there is another company, Sunshine Company, a listed company who is already in the hospitality industry. The existing capital structure and equity beta of the two companies are as follows, right? So for tech company, you have a debt equity structure of 1:2. So every one, if debt is 1, equity will be 2. And the equity beta is 1.5. Sunshine also you have 2:3 and 2. Assume there is no corp tax, the risk-free rate is 3% and the market risk premium is 5%, right? So I have explained this almost every day in our revision. Okay, I'll go through it once more as well. So there is a company called Tech Company. They are currently in software. They want to diversify into hospitality. Okay, we know that software and hospitality, both those industries, they have what we call the business risk as well as the financial risk. Hospitality also has the same business risk and the financial risk. Now they gave me tech companies equity beta. They told me that tech companies equity beta is 1.5 currently, right? So this 1.5 is reflecting business risk of software plus financial risk of this particular company. This financial risk was that 1:2 structure. Okay. Now when they are going to diversify into hospitality, it doesn't make sense to use this 1.5 anymore. Why? Because although the financial risk is still the same, business risk changes because now the industry is changing, right? So business risk will obviously change. It doesn't make sense to use the same 1.5. So now what are we going to do? We are trying to get the business risk of the hospitality industry. So how do we do that? We take somebody who is already in that industry, in this case Sunshine Company. Okay. So the question is telling me Sunshine Company, they had an equity beta of 2. Okay. So they have an equity beta of 2 means this 2 is reflecting the business risk of hospitality, which is good, we want that. But the financial risk of Sunshine Company, which we don't want because we don't have this 2:3 structure. If you look at Sunshine, their debt equity structure is 2:3. Ours is 1:2. So we don't want that 2:3 financial risk, right? So what do we have to do? Right? What do we have to do? We need to somehow remove the financial risk component. So that is only called de-gearing the beta. Okay, so we take this equity beta and we de-gear it. Okay, we get something called the asset beta. Then what do? We re-gear that asset beta to reflect our company's financial risk. Okay, so that is what basically has to be done. So first step is to de-gear Sunshine Company's equity beta. That is only step number 1, right? So there is an equation for this. Okay, there is an equation for this. You can look at your formula sheet. Okay, you can see the asset beta formula, right? So usually for the purpose of our exam, we only consider the first fraction. Okay, so this value of debt part and the beta debt, all of that you can completely ignore it, because we make an assumption in this paper that beta debt is always 0. Okay, so just the first bit of the equation you need to use to go ahead and do the de-gearing. Okay, so let me copy down the the equation. So equation is this: beta asset equals to the value of equity over value of equity plus value of debt times 1 minus t into beta equity, right? Fine. So if you look at Sunshine, their equity debt ratio was 2:3. Okay, so that's what we need to use. Value of equity, value of debt, you can use the ratios. So 2:3 and equity beta was 2. And which one was 1 second? Yeah. So debt is 2, equity is 3. Okay, so be careful, don't put it the other way around. So equity is 3 over value of equity again 3 plus value of debt is 2 times, they are telling me to ignore tax, so I can just ignore it. Okay, into the beta equity was 2, right? So that will give me beta asset, which is 1.2. So de-gearing is done. Now next step is to re-gear beta asset. For that also you use the same equation. Okay. Actually, since they told me to forget about debt, let me just remove this, because you might get confused and make that 2 also 0. So just take it as 3 plus 2, 5. Okay, so now let me do the re-gearing. How do I do that? Okay, so same equation that we have on top, right? Same equation. This equation has to be used. Okay, so this time we have beta asset, which is 1.2. Now value of equity, now we have to take the equity debt ratio of our company, which was 1:2. Okay, so if you remember, it was 1:2, right? Equity was 2, debt was 1. So value of equity is 2 over 2 plus 1 into beta equity. That's what we want to find out. Okay, so once you rearrange this, you should get beta equity as 1.8. Finally, use the capital asset pricing model to find KE. So KE equals to risk-free rate plus beta equity times risk in the market minus risk-free rate, right? Question told me that the risk-free rate is 3%, risk premium is 5%, right? So 3 plus beta equity is 1.8 into risk premium, they told me it was 5%. Remember, RM minus RF is also called risk premium. So if they give you risk premium, you can directly put that figure itself. That should give me the cost of equity. Should be 12%. So always you have these 3 steps. Okay, de-gearing, re-gearing, and then using capital. Guys, if you have questions, please let me know, okay? Because like I said, this question is a little, this question paper tends to be a little on the heavier side for some reason this session. Heavier side as in they are asking a lot of calculations. So next week we will have another mock. Okay, it will be entirely online. You can try it out, send me the answers. I will, I'll send each of you a personal email, giving you feedback with regard to your answer script. Okay. Right. So KE is 12%. We'll see if that answer is there. Okay. So we just have to type in the answer in this case, right? So right, so 12%. Next. Right, so now they are asking you about current market value of a loan note. Okay, so loan note market value, right? It says there Bubblegum Company has 12% convertible loan note. So it's a convertible loan note outstanding, maturing in 5 years time to be redeemed at face value of $100 per note. Alternatively, each note can be converted into 40 ordinary shares each with a nominal value of $1 after the 5-year period. The company's ordinary shares are presently trading at $2 each, projected to grow at an annual rate of 5%. Their pre-tax cost of debt is 10% and the after-tax cost is 7%. Okay. Now, it's a convertible loan note, right? So you have 2 options. In 5 years time, if you want per loan note, you can go for redemption. That means for every loan note, they will give you $100 and call it a day. That is one option. Or you can go for a conversion, meaning instead of taking the cash, instead of taking the $100 per loan note, you can convert one loan note into 40 ordinary shares. So when will you do the conversion? When you do the conversion, if it happens to be more than $100 per loan note, what you're getting happens to be more than $100, then you will be more than happy to do the conversion. Okay, so this is a classic example of how to get market value of a convertible. First you have to decide whether you're going to redeem or whether you're going to convert. After that, get the market value. So market value, if you remember, it was similar to like getting a present value calculation. Okay, so see if you can do that. I'll give you 5 minutes. This is something again we have done so many times. Very simple. Option 1, which is, you're saying it's 122. Okay. Okay, so let me first decide what the conversion value is. Okay, because that's the first step now. Let's see if I can use this square now. Yeah. So, conversion value. So, this conversion is going to happen in 5 years time, right? So, first I need to figure out in 5 years what will be the market price of a share in this particular company, right? So, they are telling me the company's ordinary shares are presently trading at $2. So, currently it is $2, but it's going to grow at an annual rate of 5%, right? So, I'll multiply that by 1.05 to the power, how many years am I talking about? I'm talking about 5 years. Okay. So that is going to be the price of a share. Am I going to get one share? No, I'm going to get 40 shares, right? So let me multiply that by 40. So the conversion value will be $102.1 per loan note. Now compare this with the redemption. Redemption is $100, right? So since conversion is going to be more than redemption, the shareholder, sorry, the debt holder will choose, the conversion option. Okay, so now we know that we are going to convert because it's more. Okay, right. So we have decided that we are going to go for conversion. So now just a matter of getting the market value. So how do we do that? Okay, so conversion is going to happen. Right. So we have our years. Year 1 to year 5, there will be an interest payment. Now usually we take interest times 1 minus t, right? But in this case, if you see the question, okay, if you see the question, they don't give me the my tax rate, right? So because of that, we don't have a choice. We have to just use the normal interest, right? So which is going to be 12%. So 12% into 100, 12, right? But be careful. If you are not going to use interest 1 minus t, you can't use the after tax percentage of 7. Because we did not include 7, right? So that's the reason they have given pre-tax also. So in this case, since we are not making the adjustment for taxation, the rate that we are going to use for discount factor also has to be pre-tax rate, which is 10%. Okay, so be careful there. So the interest is going to be 12, and in year 5 we will go for conversion, which is 102.1. Okay, so then you need to these are the cash flows. Then you need to use either the annuity factor or the discount factor at 10%, the pre-tax rate. Okay, right. So 5 years annuity factor at 10% will be 3.791, and 5 years discount factor at 10% is 0.621. Okay, the present value. So this will be 45.492. This will be 63.4041. Take the total, that is the market value, which is 108.89. I think they told you to the nearest dollar, right? So 108.89 means 109, which is I think C. Yeah, C. Okay. So this is just a normal market value of a convertible. Only thing is in this case that tax, usually we are so used to taking the after tax rate because we are thinking from the perspective of the company, right? But in this case, since the tax rate is not there, we don't have a choice. Right. So let's look at the next one. It's 109. Okay. Then they're saying here, what is the amount of equal annual lease payment for 4 years closest to? So they're talking about a lease. Okay. The net present value of a lease agreement calculated at a 10% discount rate yields a negative value of $21,003. Okay. If you are going to get the present value of the lease payment, it's going to be $21,003. Fine. The terms of the lease involve an immediate down payment of $10,000 followed by 4 equal annual payments with the first payment commencing at the end of the first year. Okay. So there are 2 payments that are happening as in any lease. First is the down payment itself, which will usually happen in year 0. Okay, and then year 1 onwards we are going to pay these installments, the lease payments. That is, they are telling me 4 equal annual payments. They are not telling me how much that lease payment is. So the question is asking me basically what is that lease installment that we have to pay for 4 periods, right? So that's what they are asking. They have given me the NPV. They are telling me if you take the initial investment and the lease payment and get a present value, answer will be minus 21,003. Okay. So how do you think you can figure out what the lease payment actually is? So I'll give you a hint. Start with drawing the timeline. Any lease payment, that's the first thing. Draw a timeline and see what's going on. After that, things will kind of fall into place, right? So I'll give you 2 minutes. See if you can figure out what actually has to be done here. Okay, so like I said, get the timeline done first. Okay. Okay, so this is the timeline. So we have year naught, year 1, year 2, year 3 and year 4, just 4 payments, right? So the initial down payment, they told me it was 10,000, so that will happen immediately. I'll just check if it's 10,000. Yeah, initial immediate down payment 10,000 followed by 4 equal annual payments, right? So the 4 equal annual payments, there will one payment will happen here, lease payment 1. I'll call it lease pay 1. Then lease pay 2, lease payment 3 and lease payment 4. Okay, so all of this, okay, all of these will be one figure. Okay, so I can just call it X because it will be a fixed amount every year. Okay, so 4 different payments will happen. Okay, right. So now they are asking me basically what is the answer for this X, right? We have the NPV. So let me put the NPV structure down first. So I have years. Okay, in year naught, I have the initial down payment of 10,000. And then from year 1 to year 4, there will be this lease payment which I am going to call X. Okay. Right. So now let me get the net present value. Right. So I have the cash flow here. Let me discount it using either the discount factor or the annuity factor at how many percent? I think they told me calculated at a 10% discount rate, right? So 10% present value. So here not always is going to be 1. So this will be a minus 10,000. Okay, now I need annuity factor at 10% for 4 years, right? So that I can go to the table and get 10% annuity factor for 4 years is 3.17. Okay. Now I don't know what this answer is, but they told me that after everything is done, the net present value, the answer will be negative 21,003. They told me that. Okay. So now I just need to work backwards, right? If this is 10,000, what should this figure be in order for the answer to become minus 21,003? So very clearly, if this was minus 11,003, minus 10,000 minus 11,003, I will get my answer minus 21,003. Okay. So now work backwards. X into 3.17 should give me an answer of 11,003. So if I want X, what should I do? 11,003 divided by 3.17. So X will be 3471. That is only the annual lease payment. Okay. See, it's a simple thing. It doesn't strike us at the beginning. That's the only difference, right? So how do we make sure that we get it at the exam? You have to start somewhere. That's what I said, start with the timeline. Okay, once you get the timeline, the next thing is there is an NPV, right? So put the NPV structure, maybe something will click, right? This is not something we have done before, but this is actually the simplest form of lease actually. Think about it, right? So just a matter of starting it off. If you're scared to start, it will not click you. Okay, right. So 3471, let's see if that answer is there. Yeah, 8. Okay, if you want to take it down. let's move on to the next one. They're saying indicate by clicking on the relevant boxes whether the following statements are true or false relating to working capital. Okay. First is saying the two primary objectives of working capital management is to balance between profitability and liquidity preference. That is true, right? That is what we actually do when it comes to working capital management. We are focusing on balancing profitability and liquidity. So that's true. Then the next one is invoice discounting is usually performed on the entire receivables ledger. Invoice discounting, if you remember, if you have a lot of invoices, meaning you have sold the goods, people have to pay you, right? So you have issued the invoice, you have so many invoices, let's say 10 invoices, you want the cash immediately. But obviously the customer is not going to pay you immediately, right? Because you gave a credit period. Now what you can do is you can take those invoices and show it to somebody called an invoice discounter, keep that as a guarantee and take a loan, a short-term loan, right? So here they are saying usually invoice discounting we do it for the entire receivables ledger. That is wrong. We usually hand pick a few invoices, maybe 2 or 3 invoices, and then we show those invoices and ask for the advance, right? So not the entire ledger, just a few invoices is what we use, right? So this is false. Third is saying an aggressive approach to working capital financing can increase profitability. I'm sure you know this. Aggressive nature means we don't care about whether we have cash in hand for any emergency. Okay, we just want profit. Okay, so we want to focus on profitability. That is what we do if we have the aggressive approach. So that is true. Conservative on the other hand means we are a little scared. You know, even if the profit is a little low, it's fine. We don't want to come to a situation where we don't have cash when we need it. Okay, so if you are conservative, you will focus more on liquidity rather than profitability. Finally, a disclosed factoring arrangement will be an advantage to the seller in upholding its business reputation. So disclosed factoring means you are telling your customers that now onwards we are using a factor to collect debts. They are saying that's a good thing for the reputation, which is definitely false. Okay, because if you are going to tell that you are going to use a factor, most of the time there is this assumption that only if a business is not doing well, we go for factoring arrangements. So the moment your customer knows that you are using a factor, they might think, okay, they are going to go bankrupt. So business reputation wise, it actually is not a good thing for you. So not an advantage, right? So that's false. So it will be true, false, okay? So when you use a true, false, okay? That's how when you click, it will appear in red. So that means you have selected the answer. Okay. They are asking for a theoretical X rights price. Seems simple. Write out. There is an equation. Start off by writing the equation. And see whatever you need to input into that equation. Okay, I'll give you 5 minutes. Okay. So it says no company intends to initiate for a 1:3 right issue, offering shares at a 20% discount to the current market price. Presently, the company's EPS stands at $2 with shares trading at an earnings yield of 5%. Additionally, Snow Company's market capitalization is valued at 240 million. So they are asking for TERP rounded to the nearest whole number. Fine. So first step, guys, honestly, is to take down the equation, right? Because only then you will know what you are looking for, right? So TERP is the market value of shares already in issue plus proceeds from new share issue divided by number of shares after rights issue. Okay. So market value of shares already in issue. Let's see if that figure is given to us, right? So they're telling me additionally Snow Company's market capitalization is valued at 240 million, right? So how do we get market capitalization? The market price of a share into the number of shares. So that is only the market value of all your shares outstanding, right? So the first part, actually we have the answer directly. 240 million. Proceeds from the new share issue. Okay. So if I need to know the proceeds from the new share issue, first of all I should know how many shares did I issue in the first place. Okay. So if you see here, it's a 1:3 rights issue offering shares at a 20% discount to the current market price, right? So first thing I will do is let me try to get this current market price. I don't have it. Okay, I have the total market value, the 240 million, but per share I don't have the figure, right? So they're saying presently the company's EPS is $2 with shares trading at an earnings yield of 5. So chances are that that information is what I need to use to get this market price of a share. Okay, current market price of a share. Now there is an equation like this, right? The market value of a company equals to the total earnings divided by earnings yield. Okay, we learned this in the chapter business valuation. There is the equation like this. Okay, now we don't have total earnings figure, but we have earnings per share, right? So I can tweak this a little. So instead of saying market value of the whole company, I can say the market price of one share equals to the earnings per share divided by earnings yield. Okay, so this was the whole company. So if I want for one share, instead of taking all the earnings, I will only take the earnings of one share, earnings per share. Okay, so now I know the EPS. They told me it was, I think, $2 and the earnings yield is 5%. So $2 divided by 5%. The market price of a share is 40. Per share. Okay, that's the first thing. Now I have the market price of the share. I have market capitalization also. Okay, so market capitalization is the market price of a share into number of shares, right? So I know market capitalization already, it's 240 million. So I'll just get the number of shares also. 240 million, 40 into number of shares. So number of shares in issue will be 240 million divided by 40, which is 6 million shares in issue. Okay, so this is without thinking about any of the rights. Okay, so only thing I did here was I got the market price of a share using the market capitalization and the market price per share. I got the number of shares in issue. Okay, so now I have to decide what is happening with regard to the rights. Okay, So take this down first and then I will show you what happens with the rights. Issue, this is before rights, okay? Okay. So now let me read what they're talking about the rights issue. They said it's a 1:3 rights issue and the price is at a 20% discount to the current market price, right? So the rights issue, how many shares? 1:3, right? So rights, we have 6 million shares in issue. If you divide that by 3, you will know that we are going to issue 2 million shares under the rights. Okay. And what is the price we are going to issue at a 20% discount, right? So currently it's $40 per share into 80% will give you the discounted price, which is $32 per share. That's the rights issue price. Okay. So now we have everything that we need for the TERP. Okay. So let me go here. Market value of the shares 240 million, that's fine. Proceeds from the new share issue. So I am going to issue 2 million new shares and each share at $32, right? So this will be 2 million into 32. And number of shares after the rights issue. Before rights I had 6 million, after rights I had 2 million. So 6 plus 2 will be the number of shares after. Okay. So if you want the TERP, I'll put it on this side. It's 240 plus 64 million divided by 678 million, which is $38 per share. Okay, so always work step by step. Okay, based on what the question is giving you, see what can be calculated. Okay, so from that point, because now see, the moment you see earnings yield, this equation should have struck you. Because in our entire syllabus, earnings yield we only spoke about in one place, in business valuation, and we used it to calculate market value of a company. So if they are giving me earnings yield, I have to somehow use that. So the only equation that will work out is this one. So once you figure out that it's going to be from the business valuation part, everything else will start falling into place. Alright, so $38 per share. Need to put that here. So just the numbers, right? Don't put per share. 38. Okay. Which two of the following statements regarding financial markets and economic policies are correct? It's saying higher taxation is expected to boost overall demand within the economy. Now, if you have a lot of tax, you and I, we have to pay more taxes. So then the disposable income that I have in hand is going to reduce. So when I have less money to spend, obviously the demand is not going to get boosted, no. Only if I have a lot of money to spend, the demand in the economy will get boosted because I want to go and buy things. So what they are saying here is actually not correct. If there is higher taxation, it's not going to boost the overall demand in the economy. Okay, so that can't be an answer. Then it's saying supply side policies will lead to raising the capacity of the economy in producing more goods and services. That is actually true. So supply side policy, actually what we are trying to do is, we try to help the private sector, we try to do something to increase the capacity of our economy. Okay, so if you are going to have a supply side policy, you are actually trying to increase supply. So when that happens, the capacity or the goods producing capacity will actually increase, right? So that is definitely correct. Maximizing market share is an example of a corporate's financial objective. Not really. Financial objective has to have something to do with profits. Okay, so this is not that. D. Peer-to-peer allows people to lend money directly to small businesses without going through a formal financial institution. That is true. Instead of going through a bank, if you know the person directly and they are willing to lend you the money, then you get the finance that you want without an intermediary. Okay, so that is correct. So answers there will be the second one and the fourth. Which of the following statements regarding value for money is correct? I hope you know what's value for money. Value for money is how to measure the performance of a not-for-profit organization. So there are 3 E's that we have to consider: economic, efficiency, effectiveness. Okay. So which of the following is correct? Number 1, acquiring resources at the lowest cost. Is this one of the 3 E's? Is it one of the 3 E's? Getting your input, your resources at a lowest possible cost? Yes, right? It is economic, right? So yes, the first one is there. Implementing innovative marketing campaigns, it has nothing to do with efficiency or effectiveness, so can't be that. Maximizing shareholder dividends also, no, not part of value for money. Ensuring maximum output with the given resources, that is only economic, right? So with what we are going to input, we want to take the maximum out of it. So that is economy. So 1 and 4 is correct. So answer there is D. Okay. In a booming stock market, investors observe rapid price fluctuations following the release of listed companies' annual reports. So they are saying after the annual reports are released, the prices are fluctuating. Which form of market efficiency best describes this phenomenon? Okay. So if we are going for a weak form efficient market, even after these reports are issued, there won't be much of a price fluctuation. Okay. If we are going for semi-strong form, then actually yes, if there is publicly available information released, it will reflect in the share price. Okay. So answer there is semi-strong. But look at strong form. If it was strong form, guys, even before these annual reports are released, when it was private information, only people within the organization knew about it. Even at that point, the market is actually very efficient, so the prices would have actually reflected whatever is said in those annual reports. Okay, so weak form means it does not reflect even after the public information is released. Semi-strong form, it will reflect after public information is released. Strong form, it will reflect even once the information is private. Okay, so this will be semi-strong form. Okay, what's the cost of equity of purple company? Very simple. They are asking cost of equity. In our syllabus, there are only two ways to calculate it. One is dividend valuation model. Second one is the capital asset pricing model, CAPM. Okay, so one of the two. I don't see anything to do with CAPM here, so most probably we have to use the DVM. Fourth one is I know the question you talk about, Yamna. 1 second, guys. Did I say something else? So first one, acquiring resources at lower cost is economy. 2 and 3 is not part of value for money. Ensuring maximum output is efficiency. Did I say economy? I'm sorry. Okay, it's efficiency. Effectiveness means the output will be in line with the company's main objectives. Okay, so first is economy, fourth is efficiency. Effectiveness they have not mentioned in this question. Okay, sorry. Okay, if I said something else, I might have said economy. I feel. Right, so cost of equity, clearly using dividend valuation model. Take some time, see if you can do it. it says here, Purple Company, which is about to pay a dividend, typically offers a dividend yield of 10% based on its ex-dividend share price. The current market price of its shares is $55 cum dividend, right? So whatever you are doing, we have to first of all convert that to ex-dividend, okay? But unfortunately, we don't have the dividend figure, okay? Because if they said, okay, dividend is $2, then 55 minus 2, 53 is ex-div. But here we don't have that, okay? Then they're saying, company has 2 million shares in issue. They have a payout ratio of 20% and a return of 15% on its equity. What's the cost of equity of Purple Company? Okay. Right. So what I will do is, I know I have to use dividend valuation model. So let me start by writing down that equation. Okay. So I need the cost of equity using dividend valuation model. Okay. Right. So they are asking me for KE, right? So the best option is to write it in this method. I'll show you the formula sheet. Second is a little slow. So they are asking for KE now, so instead of writing the first one, it's better to write the second one. KE equals D naught times 1 plus G over P naught plus G. Okay, so let me write it that way. Okay, right. So the dividend is not very clear because I don't have it directly with me. But they are asking for growth also, no? So let me do what I know first, right? So let me calculate growth. I can either use two methods, extrapolating past dividends or using Gordon's growth model. Here they are giving me the payout, they are giving me the return on equity. So clearly I have to use Gordon's growth model, right? So let me do that. So G equals BR. Right, so I know that the payout rate was 20%, meaning retention will be 100 minus 20, which is 80%. Return on equity, I think they already told me it was 15%. So to get growth, it's just a matter of multiplying 15% into 80%, which is 12%. That's the growth rate. Okay, so I hope you have that taken down. Okay, fine. So now I need what else? I need the dividend and I need the market price, the ex-div market price. Okay, so let's see what I have here. They are telling me the current market price of its shares is 55 cum div. Okay, so I know that the dividend yield is 10%, right? So 55 is talking about including that dividend, right? So 10% means, what I am trying to say here is, the cum div price, which is 55, is when we are talking about 110%, because it's including the dividend payment. What was the dividend payment? The dividend yield was given to me, it was 10%. I want to know what is the dividend. I want to know the ex-div, meaning how much this market price will be after I deducted the dividend. Okay, so 55 is when it is 110%. How much will it be when it is 100%? Okay, so 55 divided by 110 into 10. 1 second. Get that figure. Okay, so into 10, right? I just want to know what is that 10%, the dividend portion. So the dividend portion you can calculate, it's actually $5. Okay, so I'll repeat what I did here because we don't do this very often, right? We know that the cum div market price of the share is $55, meaning the market price plus the dividend is going to be 55. I know that the dividend is 10%. So 55 is including the 10%. So that's why I'm dividing it by 110. If you want to know what that 10% component is, you have to multiply it by 10 again. So now I know that $5 is the dividend that I paid. Okay. So now if I want the ex-div share price, all I need to do is ex-div market price of a share, that is simply 55 minus 5, which is 50. Get it? Okay, so now it's just a matter of putting this into this main equation over here. So I'll take it again. KE equals to dividend. I know we paid a dividend of $5. 1 plus growth rate is 12% over XD market price is 50 plus 12%. So that will give me KE, which is 23.2%. Okay, so that will be the cost of equity. Okay, if you have questions, ask me. So again here everything is fine except for the fact that what did they complicate here? They didn't give me the XD market price. They will do something like this, right? This paper is a little more on the heavier side. Okay, I do agree. In your real paper, you can't expect every question to be a calculation like this, right? There won't be time, right? So it's a mock exam, right? So they want you to cover all areas as much as possible. Okay, so you can expect in your exam. I think we did a paper last week, if you remember. Let me think. Did we do a paper last week? There was a particular day, right, where we did a paper. Was it last week or the week before? I can't remember. But there you would have seen section A was slightly less calculations, right? So here you can see every question is a, one was convertible loan note, then DBM, and then de-gearing, re-gearing. So basically everything under the syllabus is given, okay? The reason for that is because they want you to touch everything before your exam, okay? So your paper, I'm sure, will be a little less heavy, right? Okay, right, let's quickly finish this off, but yeah, even the next one is a long question. Let's see what it says. So this will be 23.2, right? B. It's to do with working capital management, right? So it says Cyprus Company's management has an annual credit sales totaling 50 million with accounts receivable amounting to 10 million. Working capital is funded through an overdraft at an annual interest rate of 10% and the company's cost of capital is 13%. Assuming 365 days in a year, what would be the yearly reduction in finance cost if the management shortens the collection period by 40 days? So this is a cost versus benefit analysis. It's part of working capital management. Okay, so see if you can do that. There are about 5 steps. I gave you the steps. If you follow them, you should be able to get that reduction in finance cost. So this is not the benefit section, right? Benefit we are not doing here. This is the cost. Okay, so the first step is you need to calculate the receivable days. Okay, so I know that the credit sales is 50 million and the receivables is 10 million. So current receivable days has to be calculated. That is step number 1. So let me take that down. Existing receivable days. Okay, so receivable days, there is an equation equals to receivables over credit sales into 365. Receivables, they told me it was 10 million, sales is 50 million. So 10 divided by 50 into 365. So existing receivable days is 73 days. Okay, first step. Then they are saying this particular company, they are going to reduce the receivable days to by 40 days. Okay, so now it is 73. They are going to reduce it by 40 days, right? So the new receivable days is actually new receivable days. It will be 73 minus 40, which is 33 days. Okay. Now, if the receivable days is going to change, then the receivables figure will also change, right? So that also we have to cater now. So new receivables figure. So same equation I am going to use. If the receivable days is going to be 33, how much will the receivables be? Divided by sales is 50 into 365. So new receivables will be 4,520,548. Okay. So what used to be 10 million, the receivables used to be 10 million, it is actually reducing to 4.5 million odd. Okay, so now you can take the reduction in receivables. Used to be minus 4.5, 4,520,548. So reduction is 5,479,452. Okay, so your receivables will reduce by this amount. Why? Because people are going to pay you early. Okay, so if it reduces, then you don't need to take an overdraft. So you can save on your finance cost. So they told me that the overdraft had a finance interest rate of 10%, right? So this reduction, it will save you interest of 10%. So reduction in finance cost, that will be 5,479,452 into 10%. So we are talking about 547,940. That's the answer. Okay, so it's a very classic example of the cost versus benefit analysis. Take it down if you haven't taken it down yet. Okay, right. So that will be, the answer will be C then. Right. Something to do with the FRA. Okay, so it's saying company a manufacturing entity finds itself in need of a 4 million loan for a 6-month period which it requires in 3 months time. So meaning we don't need it today, we need it in 3 months time. So for example, now we are in the month of say November, December, January, February. We need it in February for a period of 6 months. So from February, March, April, May, June, July, August. From February to August, we need that loan of 4 million. Okay. To mitigate potential risks stemming from interest rate fluctuations, they are considering a forward rate agreement offered by another bank with a quotation of a 3 to 6 forward rate at 11% or a 3 to 9 forward rate at 12%. Should the loan interest rate on the date when the loan is taken up, should the loan interest rate on the date when the loan is taken up is at 10 million, is at 10%, I'm sorry, I don't know why they keep using the word should, okay. So they're saying if on the date that you're taking the loan, if the interest rate in the market is 10%, what is the payment or receipt company A will make or receive with the FRA bank? So they are saying we are taking the loan from one bank, we are taking the FRA from another bank. So if the actual market rate was 10% on the date of the loan, will we be paying extra to the FRA bank or will the FRA bank pay us some amount? That's the question. Okay. So it's a very simple scenario of FRAs. Okay. So see if you can get that answer. So first thing is you have to know which FRA to choose. There are two, no, 3 to 6 and 3 to 9. So if you don't know what 3 is and what 9 is, then you have a problem, right? So we want the loan in 3 months time, right? So that is what the first number is talking about. So the loan is going to start in 3 months time for a period of 6 months. That means 3 months plus 6 months, the total of 9 months from today. After 9 months from today only, we will end this loan, right? Okay, 9 months from today only, we are going to end this loan. So that means we need to go for a 3 to 9 FRA. 3 to 6 means we are going to start in 3 months time and end in 6, we are going to start in 3 months from today and end in 6 months from today, meaning the loan you will only have it for a period of 3 months. That's not enough for us, right? So the FRA that you will have to choose is 3 to 9 FRA at 12%. So it's a 3 to 9 FRA at 12%, and now what's happening? The market rate happens to be 10%. Okay, so that means what's going to happen? You have told the bank I will pay 12% and fixed it. Okay, when you take the loan, they are only charging you 10%. So that extra 2% that you promised to pay, you have to actually pay them, right? So the amount that you will have to pay the bank, A pays bank an extra 2%. So the loan was for how much? I think it was 4 million, right? Let me check that. How much the loan was for? 4 million loan for a 6-month period, right? So you have to consider that 4 million into an extra 2%, but only for a period of 6 months. Okay, so that will be 0.04 million. So we can put it as 40,000. So A pays the bank 40,000. This is B. It's simple, that is. Right. Let's go to the next one. Indicate by clicking on the relevant boxes in the table below whether each of the following financial instruments that are commonly in use by organizations are short-term or long-term financing, right? Okay. So we can go through this quickly. Commercial papers, usually they are short-term. Okay, I have mentioned this at the beginning itself. They are usually short-term. Preference share capital, the moment we are talking about shares, we are talking about long-term. Treasury bill, this is something that the government, if they want a loan, they will issue something called a treasury bill. Public can buy it, government will pay interest for a fixed period and then they will repay the principal. Usually this is not long term. Okay, so it is considered a short term source. And a banker's acceptance is also short term, right? So the answers there will be short term, long term, short term, short term. Okay. The next one, which of the following statements accurately describes the differences between the traditional theory and the Modigliani-Miller theory regarding capital structure? Okay, so immediately you have to kind of see the graph. Okay, so if you are talking about traditional theory, what are we actually talking about? We are talking about this situation. So I'll just draw it. The cost, sorry, this is straight line, cost of debt, WACC, and the cost of equity. Okay, so what is the situation? WACC actually dropping to some extent until the optimal capital structure, and then it starts increasing, right? So this is the traditional view. So let's see which of these four is actually describing that. So first one is saying traditional theory assumes that the cost of capital remains constant regardless of the capital structure, while Modigliani and Miller suggest that the cost of capital increases with higher levels of debt due to financial risk. Now, even before I read the Modigliani and Miller story, they are saying traditional theory cost of capital or WACC, weighted average cost of capital, it's constant. That's wrong, no? Regardless of capital structure means they are saying whatever the debt percentage is, doesn't matter, it's going to be the same, which is wrong because in traditional theory it was a U shape. Okay, so I don't have to waste time thinking about Modigliani and Miller. I can definitely cancel that off. That is not an answer. Okay, so A is wrong. Then B is saying the traditional theory asserts that the value of the firm is unaffected by changes in capital structure. Now, if the WACC is itself going to change, weighted average cost of capital is going to change, market value of the firm will also change. There was a an inverse proportional relationship between the two, right? So we said that if the WACC is higher, market value of the company is lower. If the WACC is lower, market value is higher, right? So definitely them saying that the value of the firm is unaffected is wrong, because if WACC is getting affected, market value will get affected. Right, so B is also definitely out. C is saying the traditional theory emphasizes the importance of minimizing the WACC through optimal capital structure decisions. That is true. We try to minimize the WACC by keeping our optimal capital structure, while the Modigliani and Miller theory argues that capital structure decisions are irrelevant to WACC in a perfect capital market. So if you take M&M without tax, M&M without tax, if they are talking about tax, they will say M&M with tax. Okay, so here they are talking about M&M without tax. Actually, M&M without tax, it said that the capital structure is irrelevant to WACC. Why? Because although cost of debt is cheaper, the cheaper debt will be counteracted by the fact that cost of equity will start increasing. Right, so what they are saying there is actually correct. It is irrelevant. Okay, so C seems to be the answer. I'll read the other one as well. The traditional theory advocates for maintaining a balanced mix of debt and equity to maximize shareholder wealth, whereas M&M suggests that the firm should minimize financial risk by avoiding debt. That's wrong. Okay, because in M&M with tax or without tax, they didn't say avoid. In fact, in the with tax theory, they are saying go for 99% debt, right? In the without tax theory, they said it doesn't matter. Whatever debt you have, whatever equity you have, it doesn't matter, right? So nowhere does M&M mention that you have to avoid debt. That is completely wrong. Okay, so the answer there will be C. Right, so this is the last question under section A. It's saying the current euro US dollar exchange rate is $2 to the euro. ABC is a Eurozone company making $1,000 sales to a US customer on credit. By the time the customer pays, the euro has strengthened by 20%. What will the euro receipt be? Euro has strengthened by 20% means you have to first figure out, okay, what is the new exchange rate. After that, you can figure out that $1,000 when I convert it to euros, how much will I get? Okay, so they're saying euro is strengthening by 20% means now 1 euro bought me $2 before. If the euro is going to become even more stronger, then that same euro will give me more dollars, right? So $2 will become 20% more than that, right? So let's see what the new exchange rate is going to be. Right, so currently it's like this, but now what's going to happen? Euro is going to strengthen, right? So euro strengthens, meaning now with 1 euro I will get more dollars. So how much more? 2 into an extra 20%, right? So I put it as 120%. It will become $2.4 for the euro. $2.4 to the euro, right? So now let's see how much I'm getting. I think it was $1,000, right? Yeah, so they are going to, I'm going to sell to a US customer. He's going to give me $1,000. When I convert, how many euros will I get? Simple. Okay, so $1,000 divided by 2.4. So that will be 416.67 euros. That's how much I will get to hand. Okay, so 416.67, which is A. Right, so that's it for section A, right? So I'll quickly take attendance, we'll take a break and we can start off section B and C.